Welcome to Larkin Gowan Insights, accountancy and business advice for all, a series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance with a variety of presenters from across our specialisms. So, let's get on with today's show.
In today's episode, we are joined by our personal tax specialist, Emma Walker, and we'll be talking about succession planning. Hi, Emma. Would you like to introduce yourself a little bit?
Hi, Megan. Yeah, my name's Emma Walker. I work in our private client trust and probate team here as a tax senior, and I'd like to join you guys today to talk about the personal tax impacts of succession planning.
So Emma, it's the 29th of August whilst we're recording this. We've obviously got the October budget coming up right in time for spooky season. Do you foresee any frights coming in that?
Well, potentially, there's been a lot of talk for a long time about some real big shake-ups with capital gains tax, which is going to be really relevant for what we're going to be talking today. But there isn't any set details out as yet as to what we might be expecting here. Any rates and allowances that I talk about today, I'll say as it is as at today, but obviously that may be subject to change. And the general consensus is any changes might not be for the better, unfortunately.
There is quite a lot of speculation that capital gains rates will be targeted, aren't there, because of the previous announcements to not touch income tax and national insurance, for example.
Yeah, absolutely. I think that is a risk, unfortunately, that capital gains tax is going to potentially be raided within this 30th of October budget.
So, Emma, looking at if the capital gains tax rates are potentially changing and looking at exiting a business, we've recently done an episode on succession planning and what that looks like from the business's point of view. But just from a personal tax perspective, what are you starting to think about if someone mentions selling their business to you?
Well, any changes that might happen within the budget, I mean, we can't be absolutely certain, but usually they're not retrospective. So they'll either look to change rates or allowances or what have you from the start of perhaps the next tax year, or they might happen on that very day. So it will depend on when the transaction sits in correlation with any changes that are anticipated to happen as to what rates and allowances that we'd be talking about for that.
So, the 6th of April 2025 could be an important date that crops up within the budget.
Very potentially, yeah, absolutely.
Perfect. So, looking at one of the positions which is quite common when you're exiting a business is just the sale of shares. What deadlines, payments, things to think about come with that?
Yeah, so the big tax regarding sale of shares that we've got to think about from a personal perspective is capital gains tax, as I say, a huge consideration there. If there is capital gains tax to pay, once you've worked out what you've sold it for versus what you paid perhaps for the shares in the first place, if there's been any movements that we've got to consider, we'll come up with a gain figure, hopefully. And then we need to work out what rates we need to apply to that gain to be able to tax that. Once we've come up with that figure, which I can sort of talk about a little bit more about the rates and things later on, we've got to make sure that we report the gain. So we'd be looking to report that on a self-assessment tax return, usually, which is due if we're reporting online and filing the tax return online, would be due by the 31st of January following the end of the tax year in which the disposal takes place. So I'll give you an example. If somebody was to sell the shares today, 29th of August, which is when we're recording this, they would be disposing it within the 2024/25 tax year. So we'd put them on that tax return, which is due by the 31st of January 2026, which seems like such a long time away, but may not feel quite so far away when we realise that that's also when the tax is actually going to be due to be paid as well. So it's something that definitely people need to bear in mind, especially if they're thinking about using the funds for other things. They need to make sure that they've set the right money aside to be able to pay the tax by that deadline.
It's a lovely New Year's treat, isn't it? To have your
Absolutely.
tax and the payment due just after Christmas, first thing in the new year. I definitely like to get them dealt with and for the client's sake as well, pre-Christmas, so that they don't have to worry about that over the holidays.
Definitely. I mean, obviously, the sooner that you can get your self assessment tax return done, I'll always say, as a private client person, absolutely the better, because then at least you know what the situation is, you know what you've got to pay in good time, and you can make arrangements for that. Some people might have the money, say, for example, sat in a bank account that they might not necessarily have immediate access to. So it's good to make sure that you've got the planning in place ready to go. So you know exactly what you've got to pay, when you've got to pay it, and you know when you need to make sure that that money is readily available for.
Yeah, planning is definitely key, isn't it? So if someone is selling substantial shareholding, and they're going to have quite a large gain, the difference between a sale going through on maybe the 31st of March as opposed to 30th of April can cause different scenarios, can't it? So different deadlines.
Absolutely. I mean, in that example, it would essentially, although the transaction's only taken place a month later, it would actually delay the tax payment by a year. So there's a huge difference there, depending on which side of the tax year that it sits on. But of course, you might not necessarily want to delay it depending on what the budget comes out with.
Yeah, yeah.
So Emma, obviously we've talked about the different rates that come into play, and what kind of rates can people be expecting when disposing of shares?
Yeah, so at the moment, obviously pre-budget, the rates that we're looking at are either 10% or 20%, or perhaps a bit of both, for the disposals of shares. So if you're a basic rate taxpayer and you've still got a little bit remaining after all of your income's been taxed, whatever's left over can be used against your gain, and it'll be taxed at 10%. Then once you've breached that basic rate limit, so at the moment that's £37,700, unless you've got pension contributions and things like that going on. Anything above that is then taxed at 20%, unless business asset disposal relief is applicable. There's lots of different conditions for that, so it's definitely worthwhile asking the question of your tax advisor ahead of time when you're thinking about selling shares or disposing them in other ways, so that we can have a look through the conditions to see whether or not you yourself meet the conditions and whether or not the company meets the conditions as well, because there might be some planning opportunities. I mean, the business asset disposal relief itself is actually worth quite a lot of money, depending on how much you're selling your shares for and how big your gain is. It can cover up to £1 million worth of gain, and it can bring down the tax rate from that 20% that we talked about earlier down to 10%. When you run the numbers, that's £100,000 worth of tax saved. So it's definitely worthwhile having that conversation before any transaction takes place.
So business asset disposal relief, which some people might have heard referred to as entrepreneurs relief way back when, is quite a hot topic for a lot of the clients that me and Alanah work with within our business team. So whether a trading business, that type of thing. So Emma, do you want to just touch on a few of the other conditions to reach business asset disposal relief?
Yeah, so there's conditions for the company, which you've touched on just there, Megan, and also there's conditions for the individual themselves who's disposing of the shares. The important thing to remember is you've got to meet the conditions as an individual for at least 2 years, so at least 24 months prior to the disposal, immediately prior to the disposal of the shares. Those conditions include either being an office holder, which could be either a director or a company secretary, for example, or otherwise just an employee of the company. So you essentially have to be working as part of the company to be able to be eligible for the business asset disposal relief. You've also got to have at least 5% of the control, and by that I mean 5% at least of the shareholding itself, of the shares available, and also at least 5% of the voting rights for the whole company as well for those 24 months leading up to the sale.
There's definitely people that will be listening in today, won't there, Emma, that are thinking tick, 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 going down the list as you're talking about it. So really it's not a strenuous task to start thinking about if they potentially are going to qualify for business asset disposal relief.
Definitely. And the other thing is, it's the sort of relief that you can really plan for as well. So if you're a couple of years out of potentially selling your business, you can actually really start putting those plans in place to make sure that if there are any that you currently don't meet the conditions of, then you can actually make very easy changes potentially, to be able to affect that so that you do meet the conditions. So, for example, you can put somebody on as a company secretary, which will potentially help to solidify the fact that they do meet those conditions for the 24-month period if there's any concern there, because you can point quite clearly at the company's house, which has said that they've been a company secretary since whenever they were put on there.
Yeah, some key discussion points, isn't there, at your year-end meetings a lot of the time is, what does the company's balance sheet look like? Who owns the shares? Are they going to qualify in the future? I suppose business asset disposal relief and the CGT rates is something definitely to look out for in the budget coming up, though, aren't they?
It's such a big relief that's worth such a lot of money. That lifetime limit of £1 million does save so many taxpayers in the position, such as your clients who are thinking about making sales of shares, such a lot of money that it's definitely something to really be considering in those year-end meetings.
So you've touched on the lifetime allowance, Emma. So what exactly does that mean for somebody that's maybe had multiple businesses over the years?
Well, the lifetime limit there of £1 million used to actually be £10 million back when it was Entrepreneurs Relief a few years ago. So it used to be a lot harder to actually meet that lifetime limit. But what it essentially means now is, say, for example, you've got somebody who sold some shares perhaps 5 years ago in a completely different company, completely different trade, and they made a gain of, say, £700,000. That £700,000 has taken up a proportion of their lifetime limit, which is now £1 million. So they've now only got £300,000 of that relief available to them, which is still worth £30,000 worth of tax saving. So it's definitely not something to just dismiss at all. But it does also mean that if somebody made a gain of, say, £5 million 5 years ago, then actually, unfortunately, irrespective of meeting the rest of the conditions, if you're selling shares now, there's no more lifetime limit available for you. So you're just going to be taxed at that 10 and 20% rate, depending on what other income sources you've got and other gains.
So again, a lot of the businesses that we deal with, we're based mostly in Norfolk area, Norfolk, Suffolk, and Essex. We see a lot of family businesses, so people wanting to pass the shares perhaps down a generation. What do we need to consider if we're thinking about gifting some shares, perhaps to family members?
This is quite an interesting one, because often when you think about gifts, you think, well, I'm not going to ask them to pay me any money for it, so it must be tax free, right? Unfortunately, that's not the case. We wish it was. And without any elections and things like that, which we can come on to in a little bit, there would be what we call a dry tax charge. It's often known as that because there's no money coming in, but you've got to pay the tax, which is not great, is it? Let's be honest, none of our clients want to be paying that. But essentially, it's treated almost as if you've just sold it to some random person for its regular market value. So if you've gifted shares worth £100,000 to your son or daughter or whoever it may be within your family, you're going to be treated as if you've sold it for £100,000. And if you've paid, say, £100 for the shares originally when the company was first incorporated, obviously you're going to have quite a large gain there, which you're then going to be taxed on. But again, we can talk about business asset disposal relief in the same way there, but there are other options available as well.
So perhaps you don't love them enough to just gift them those shares and pay the tax for them when you've not received any money. Are there any other options?
Yeah, so there is a couple of options. One of them is holding over the whole gain. So if you've just gifted that to them for free and it meets the conditions for gift holdover relief, mainly that it's a trading company's shares that you're gifting. What you can essentially do, and you both have to agree to it, there's a form that you need to fill in, but you can essentially say, okay, I would have made this gain, but I'm going to pass that gain on to you. So essentially, the person who's receiving the gift gets a lower base cost essentially. So when they decide later down the line that they either want to gift them, sell them, whatever it is that they want to do, they're going to land up with a higher CGT bill. But of course, they haven't had to pay for the shares, so it's a bit of a win-win situation, isn't it? Because you as the gifter aren't having to pay the tax, and then the person receiving the shares isn't having to pay for the shares. The other option that you might want to consider is perhaps charging some money, perhaps to cover some tax. But one thing I would say about that is, say for example, you say perhaps sold it at an undervalue. Again, we'll use £100,000 worth of shares as an example, and you gift it to, again, perhaps a son or a daughter or whoever, and say, but I'll have £20,000 for it. Firstly, we've got to consider stamp duty, because there is some consideration there, but also we've got to consider the impact of that gift holdover relief election if that's what you want to do, because there's still going to be a gain there that you've actually received money for, and the gift holdover relief elections don't allow you to hold over a physical gain, if you like, that you've physically made. So you've actually sold it for £20,000 and you only bought it for £100. You are going to be liable on that gain. It's quite good planning opportunities, though, to be able to use sort of annual exemptions and utilise that business asset disposal relief as well to try and increase that base cost for the next generation.
You touched on stamp duty, and I think a lot of the listeners will be familiar with that term, whether it be on property or shares. But for shares, it's not quite at the same level, is it, that is charged on properties?
That's it, yeah. So they are two different taxes essentially. So we've got SDLT, or stamp duty land tax, which I suppose pretty much everyone is somewhat familiar with and probably has paid at some point in their lives, on perhaps buying their properties and things like that, or purchasing some land. Whereas stamp duty itself is actually on shares. So that's typically at 0.5%.
Which is a much lower
It's much
rate.
lower, definitely, than the other rates. But unfortunately, you don't get that same initial 0% rate band as you do with stamp duty land tax, or that wouldn't potentially have been a problem with the £20,000 that I mentioned earlier. But it is just something just to bear in mind as well when you are talking about selling or gifting at an undervalue, if there is going to be money or money's worth changing hands as well, if you're sort of swapping assets and things like that, is something certainly to consider.
So we're speaking about stamp duty, capital gains tax, but is there anything else that we need to think about from a personal tax perspective?
Yeah, so when you're gifting shares, you also need to consider inheritance tax. It's never a topic that anybody really wants to think about, but it's definitely an important one, with the rate being at 40%. It's a significant sum to be thinking about. One of the things that you want to consider is what kind of transaction it's going to be classed as for inheritance tax. So if you're gifting to an individual, so say for example, I'm feeling very generous, Alanah, I'm going to gift you £500,000 worth of shares because I'm feeling really nice today. You're an individual, so that's going to be called what we call a potentially exempt transfer, or a PET, if you like, which is a lot less exciting than it sounds. It's not actually, which essentially means that at the moment there's no inheritance tax to pay. But if I pass away, say for example, in 5 years' time, HMRC may come round and say, actually, Alanah, you've got to pay some tax on this. You've got to pay some inheritance tax because Emma didn't survive long enough for it to become a fully exempt transfer. So that's the sort of more straightforward route when you're gifting to an individual. But let's say, for example, I didn't want to just outright give you the shares. I actually wanted to perhaps maintain some control of the company. I might say, for example, put it into a trust for you. So I might say, I do ultimately want you to benefit from these shares, but at the moment, I feel like I still need to have some control. So I'll pop it into a trust. Because of the value of the shares that we're talking about here, we've actually got to do some reporting, because what we're calling a chargeable lifetime transfer has taken place here, because it's to a trust. firstly, we've got to consider whether or not there's any lifetime inheritance tax to pay. Before I've even passed away, we're talking about inheritance tax charges now, and also the reporting of it, because it's in excess of my nil rate band. If we're not talking about any other gifts in the past, at the moment that nil rate band is 325,000, so you can see we're clearly over that, the £500,000 value gift there. So we'd need to consider making sure we're reporting that gift on a form IHT 100, which is something that the private client trust and probate team do quite a lot of, and also making sure that if there's any lifetime tax to pay, that actually gets paid. And the deadline for that is quite tight. It's a lot tighter than self-assessment, because that's within 6 months of the end of the month of the gift. So if I gift it to the trust today, we're talking the 30th of August is the last day of this month. So we're talking 6 months on from then, which I think would be the 28th of February 2025. So it still sounds like a long time away, but it's quite tight to make sure that you have got to get that all sorted and the tax paid within that time frame to avoid any late payment penalties and interest and all of them nasty things that we don't want to have to deal with there. The other thing to mention as well is there is also another relief for inheritance tax as well. And it sounds so similar to the capital gains tax one, it gets quite confusing. So we've got business asset disposal relief for capital gains tax, and we've got what's now called business relief. It used to be called business property relief, but they thought that was perhaps too confusing, so they've gotten rid of property and now it's just business relief. Now, there isn't a limit on that, whereas there is obviously on the business asset disposal relief, but there are some very strict conditions on whether or not you can claim this business relief. And it's mainly more important to consider the corporate side of things, whether or not the company meets the conditions as well. I don't know if either of you have seen this many times with your clients.
Yeah. We've, it's quite sad, isn't it, when you get that call and you've lost a client, but actually if you can claim business relief, it's quite a good conversation to have, isn't it?
Absolutely. Well, saving 40% on the value is a huge amount of saving. But yeah, it is very important to have the discussion with your tax advisors to see whether or not, firstly, the company is eligible, and thereon whether or not you will be able to claim this business relief, because it can really help to firstly ensure that there's no lifetime tax to pay. You might still need to report, but you might not have to actually pay any of the tax. And then when you do sadly pass away, that should hopefully then also help matters in the future as well, to make sure that we're trying to keep that tax to the minimum. Absolutely.
So what happens, Emma, if I own a business, I want to give some shares to one of my children, but I don't want to do the trust reporting, 6 month deadlines and all of that, and I just want to say, here are my shares in my will, just kind of as a standard. I pass away and it's been written up. How would that work?
So the first thing I would say is check to make sure that your will still says what you want it to say and that it is valid. There are so many times where I see people who get married, get divorced, don't realise that these sorts of things can invalidate your will. Or perhaps it still says that certain assets are going to people that actually you don't want them to go to anymore. So that's the first step, is to make sure that your will is definitely up to date and does what you want it to do. Planning for after your death, if you pop in your will that you want your shares in such and such company to go to whoever it is that you want it to go to, again, you may find that there is inheritance tax due on those shares, depending on whether or not business relief is applicable to those shares. The other thing that we need to think about is, okay, even if you've got business relief on those shares, it may impact the tax on your other assets, because there's an additional rate band outside of that £325,000 one that I mentioned earlier, which is your nil rate band, you've also got the residence nil rate band, which a lot of people can take advantage of when you're gifting a main residence of yours to what we call lineal descendants, i.e. children, grandchildren and things like that, which is worth £175,000 as well at 0%. So it's another nice saving. But it is abated away, much like your personal allowance. But this is only if you've got assets in your death estate exceeding £2 million in value. And this is before business relief or agricultural property relief, which we're not touching on today. So before any reliefs, if your assets as at your date of death are in excess of that £2 million, it starts to get abated away. And again, it's at that rate of £1 abated for every £2 in excess of that £2 million worth of assets that you've got. So that can very easily be chipped away. So it's certainly worth considering whether or not you do want to make lifetime gifts, because that abatement is only about your death estate. And if you've gifted them, they're not in your death estate.
I think that's definitely something that a lot of people either missed or haven't really considered. Is it the total value up to the 2 million and the consequences as if you're over that? I suppose it comes back down to planning again, doesn't it? Taking a view
Absolutely.
of everything you own. I know we have quite a handy questionnaire for a lot of our clients to fill in, don't we?
So I've seen quite a lot of circumstances where people don't actually realise just how much they've actually got in terms of their overall assets. When you look at all of the different bank accounts you might have, properties, other investments and things like that you've got, actually it can really start to add up. And I've also seen a large increase in terms of what's been reported across the UK in terms of who is actually paying inheritance tax, because it used to be a lot less frequent because perhaps properties weren't worth as much as they are now. And that nil rate band of 325,000 hasn't moved in such a long time, but the value of everything else has increased. Even when you're coupling in that residential nil rate band, you're still only talking about £500,000 worth of assets. Sounds like a big number, but when you break it down across all of these different assets, it's not that much. People can very easily tip over and start to have to pay that 40% inheritance tax. It's definitely worthwhile looking at your overall assets and seeing maybe there is a problem there, and can you get some help to try and mitigate that tax?
Yeah, it sounds like a good problem to have, doesn't it? If your estate's going to
Definitely.
go up up that much, but something that people might not realise is when you hold those shares, if you've got a trading company, what the value of those shares are, and there's those different ways you can work that out, and that's something that we'll obviously touch on later on in another episode. But it's something to definitely talk to your tax advisors about, isn't it?
Absolutely.
So, Emma, as our specialist, just in case I haven't put you on the spot enough already, can I have 3 top tips to close off this episode?
Oh goodness, you guys do like to put me on the spot, don't you? All right, I'd say firstly, work out when you actually want to make the sale or the gift, so you've got your timeline in place. Then I'd say definitely ask for advice before you make any transactions. At the end of the day, it doesn't matter what we know in terms of all the different tips and tricks that we can give you. If you've already done the transaction, all we can help you with is the actual compliance of it. We can't help you to save any tax on something that's already happened. And please check your will. That's what I'd really say, really bring home, making sure that your will is up to date and valid. Or if you haven't got one, please get one sorted.
Well, thank you so much, Emma, for your time today on helping from an individual perspective for succession planning. If you'd like to check out some of Emma's other episodes, she's got some really good ones, particularly one with someone from Beckett's, haven't you, Emma?
Yeah, that's right. So I spoke with Tony from Beckett's, who are financial advisors, about all things inflation, and for those who've got some savings, about how they might want to invest it and anything tax-wise as well. So that might be quite handy for people who are thinking about selling their shares and who might come into some cash.
So if you've liked what you've heard today and you've got any questions at all, please find our contact details within the show notes.
Thank you for joining us for Larkin Gowan Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website, larkin-gowan.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.